If you have ever transferred money between your own accounts, deposited proceeds from selling a vehicle or property, or moved savings to support a family member, you need to pay close attention right now. There is a genuine possibility that one of those entirely routine transactions has already triggered a flag in a federal database, and neither the IRS nor your bank will pick up the phone to inform you. That is simply not how this system operates. The system identifies the pattern, generates the report, and you discover it months later when a letter arrives that was never meant to reach you. Today I'm going to walk you through exactly which 7 account moves trigger that automatic scrutiny, why transactions that appear completely harmless are the ones that create the most serious problems, and the precise steps you can take right now to ensure your next financial move does not place you on that list. Stay until the end because move number 6 is the one that catches people who followed every single rule and still ended up under federal review. That one hits differently. I am here at Retirement Watch USA to help you understand how to protect yourself when dealing with the Internal Revenue Service. There is no version of this conversation your bank will ever initiate with you. Under the Bank Secrecy Act of 1970, every financial institution operating in the United States is legally required to file a currency transaction report directly with the Financial Crimes Enforcement Network whenever a customer conducts a cash transaction exceeding $10,000 in a single business day. That report contains your full legal name, your social security number, your date of birth, your address, and the precise amount involved. You will never receive a copy of it. In fact, the bank is legally prohibited from disclosing to you that it was ever filed. This is where people cause serious damage to themselves. When someone hears about the $10,000 threshold for the first time, the reaction is almost instinctive. They think, I will deposit $9,000 instead. I will spread it out over a few days and keep things uncomplicated. That instinct has a legal name. It is called structuring. And under Title 31, United States Code, Section 5324, structuring is a federal felony carrying up to 5 years in federal prison and forfeiture of the entire amount in question, even when the underlying money is completely lawful. The government is not required to prove that you intended to conceal anything. The pattern itself is sufficient for prosecution. Consider the example of Margaret, a 71-year-old retired postal worker from Dayton, Ohio. She sold her late husband's woodworking equipment for $14,000 in cash and deposited $7,000 on a Monday and another $7,000 the following Friday, simply because she did not want to attract attention. 6 weeks later, she received an official notice. The bank's compliance software had identified a structuring pattern. Margaret had done nothing unlawful, yet a suspicious activity report now sat in a federal database, cross-referenced against every future transaction she would make for the next 5 years. The correct approach is straightforward. Deposit the full amount in a single transaction and bring documentation establishing the source of the funds. One deposit, clean paperwork, no pattern for the system to flag. Most people operate under a false assumption that cash gifts to family members are private and invisible to the federal government. That assumption is incorrect. Under the Internal Revenue Code, any individual may give up to $19,000 per recipient in 2026 without triggering any reporting obligation. Exceed that threshold, and the person making the gift is required to file Form 709, the United States gift tax return. That form draws against the giver's lifetime exemption, which currently stands above $13 million. The recipient owes no tax. The giver is responsible for the paperwork. The mistake that costs people is not the tax itself, it is the pattern. If your daughter transfers $22,000 in cash to you and you deposit it across 3 weeks in smaller amounts, the bank does not identify it as a family gift. The compliance software identifies it as structuring. Deposit the full amount in one transaction and have your daughter prepare a brief gift letter containing her name, your name, the amount, the date, and one sentence confirming there is no expectation of repayment. Retain that letter. That is all the documentation you need. When you personally withdraw funds from a retirement account, the IRS grants you exactly 60 days to deposit that money into another qualifying retirement account. Miss that deadline by even 1 day, and the entire amount is treated as ordinary taxable income in the year of the withdrawal. If you are under the age of 59 and a half, a 10% early withdrawal penalty is applied on top of that tax liability. The solution is a direct trustee-to-trustee transfer. When funds move directly from one financial institution to another without passing through your personal possession, the 60-day clock never begins. You never hold the money, there is no penalty, and no taxable event occurs. If you currently have a rollover in progress, locate the date the withdrawal was initiated, count 60 days forward, write that date down, and confirm with the receiving institution that the funds will arrive before that deadline passes. Many retirees proceed under the assumption that moving money between accounts they personally own carries no risk. Federal compliance software does not make that distinction. Repeated large transfers between accounts, particularly when the amounts vary slightly and the timing is irregular, match the pattern profile associated with unreported income or layering, which is a recognized stage in money laundering investigations. The software does not understand that you are consolidating retirement savings. It identifies a pattern and files a report. If you are consolidating accounts following the death of a spouse, move the complete balance in a single transfer and retain both account statements showing your name on each account. If you manage accounts across multiple institutions, document the reason for each transfer at the time you execute it. One transfer, one clearly established reason, one record on file. Zelle, Venmo, and Cash App now operate under formal federal reporting requirements. Third-party payment platforms are required to issue a Form 1099-K when business-coded transactions exceed $600 in a calendar year. When you receive payments through these platforms that are categorized as goods or services rather than personal transfers, the IRS receives a copy of that report directly. A discrepancy between what the platform reports and what appears on your tax return triggers an automatic review. Personal transfers between family members must be designated as personal, not goods and services. If you receive any payment for work performed, tutoring provided, handmade items sold, or consulting services rendered, report it on your return. The platform has already reported it to the IRS. Like and share this with someone who needs to hear it, because move number 6 is the one that catches people who did everything correctly and still ended up under federal review. You sold your home. You received an inheritance. You settled a legal dispute. Each of these events can generate a deposit that triggers an automatic currency transaction report and an IRS cross-reference against your prior tax returns. Consider the situation of Diane, a 67-year-old retired school nurse from Baton Rouge, Louisiana. Her mother passed away and left her $38,000 from a savings account. The executor presented her with a cashier's check. Diane deposited it in full, which was the correct course of action. But she had no supporting documentation with her when the teller flagged the transaction for a compliance review. The bank filed a suspicious activity report. Diane had done nothing wrong, yet she spent 4 months under review and paid $900 in professional fees to resolve a question the bank could not independently answer. What Diane needed was a copy of the will or estate settlement letter, a letter from the executor identifying the origin of the funds, and her mother's account statement showing where the money came from. 3 documents. That is the complete paper shield. Deposit the full amount in one transaction and bring the source documentation with you to the bank. Once you reach age 73, the IRS requires you to withdraw a minimum amount from your traditional IRA or 401k each year. The IRS receives Form 5498 from your financial institution, reporting your exact account balance, and Form 1099-R when a distribution is taken. When the required distribution amount is not reflected in that Form 1099-R by December 31st, the system flags it automatically. No advance warning is issued. Under current law, failing to take your required minimum distribution triggers an excise tax of 25% on the amount you failed to withdraw. On a $10,000 missed distribution, that amounts to a $2,500 charge before you have spoken to a single person about it. Contact your brokerage and establish an automatic distribution for early November, well before the holiday period reduces your available attention. Then verify the calculation yourself once annually. Your required distribution amount is determined by dividing your prior year-end account balance by the applicable life expectancy factor from the IRS Uniform Lifetime Table. An underpayment carries the identical penalty as a complete failure to distribute. If you receive any income outside of Social Security, a pension, or investment distributions, including consulting fees, tutoring payments, or proceeds from selling handmade goods, and that income flows into the same checking account as your personal expenses, you have created what is legally referred to as a commingled account. When an IRS auditor opens a Schedule C examination, they hold the legal authority to review every single transaction in that account. Every deposit becomes a potential line of inquiry until you can prove otherwise, one transaction at a time. Consider Carol, a 68-year-old retired teacher from Phoenix, Arizona. She had been depositing tutoring payments into the same account as her pension and Social Security income for 2 years. When the IRS identified a discrepancy between her reported Schedule C income and her total account deposits, she was selected for examination. Carol was able to account for every transaction, but separating 3 years of personal and business deposits required 6 months of work and cost over $1,000 in professional fees. The underlying tax actually owed was less than $200. The solution is a single action. Open a dedicated checking account used exclusively for business income and expenses. Your personal account never enters a business audit. The separation itself is the legal protection. If you hold financial accounts outside the United States and the combined value exceeds $10,000 at any point during the calendar year, you are required under the Bank Secrecy Act to file a report of foreign bank and financial accounts, known as the FBAR, with FinCEN by April 15th each year. Accounts exceeding $50,000 may trigger a separate filing obligation under the Foreign Account Tax Compliance Act. Penalties for failing to file, even when the failure is entirely unintentional, can reach $10,000 per violation per year. Willful failure carries penalties of up to $100,000 or 50% of the account balance, whichever is greater. The foreign institution will never inform you of this requirement. The obligation rests entirely with you. Confirm whether you hold any foreign financial accounts and identify the highest balance in each account at any point during the year. If your combined total exceeded $10,000 at any point, file the FBAR by April 15th through the FinCEN electronic filing portal. If prior years were not filed, consult a qualified tax professional regarding the IRS streamlined filing compliance procedures, which exist specifically to resolve unintentional foreign account failures without criminal referral. The most important thing to understand about this entire system is that it is not searching for criminals. It is searching for patterns, and patterns carry no awareness of your intentions. The moves covered here are not complex. They are simply never explained to the people who need to know them most. Subscribe to Retirement Watch USA so you never miss information like this, and share this with someone who could benefit from knowing it before their next transaction.